It's another confluence of economic data, earnings, and Fed speak that should give us a better picture of how consumers may fare in the near future. My next guest believes the numbers will signal a clearer path forward for spending and is here to tell us how to follow the money. Let's talk to Gilles Moec. He's the chief economist and head of research for investment managers at AXA Group. Gilles, it's good to see you. And very confusing sort of backdrop here where the economy is better than expected. Interest rates are rising. The stock market is rising as well. And there's much debate about whether the Fed should be cutting rates in this environment. So what are you looking to this week?
Well, honestly, when the Fed decided to cut by 50 basis points, my first reaction was that maybe they were jumping the gun a little bit. I mean, there was no absolute sense of urgency, of emergency there. As you said, the economy was doing perfectly okay. My only guess is that they overreacted to some disappointing data on the labor market in the summer months. The issue for me is whether the sort of new consensus around a more prudent pace means that the Fed could stop altogether. I don't think so. I don't think they have this in themselves at the moment. My impression is that what the Fed wants to do is precisely to avoid creating a situation down the road which would be consistent with hard landing. And to do that, you need to cut rates at a steady pace without triggering any massive movements. But you still need to remove some of the restriction which is currently in the system, because we're still living with the risk that at some point the level of interest rates, which remain much higher than what the Fed themselves tell us the sort of neutral rate should be, right, there's a risk that down the road it triggers some sort of nasty lending. So steady, but on the way down.
But your data show that we are going through the second acceleration in a row on the 3-month annualized inflation rate, or maybe the core inflation rate, which would be even more significant. So why should they be cutting rates or worrying about neutral?
Yeah, it's true that if you look at the very short-term momentum, on a 3-month annualized basis, for instance, you can see that there has been a reacceleration, especially in some segments of the consumer price index, which normally the Fed cares a lot about, in particular, core services, excluding rents. So I agree that this should be pose for thought, so to speak, for the Fed. But without accidents of this nature, before we had, for instance, this hump in inflation in the first month of 2024, and we discovered in the summer that actually it was just a sort of accident. So given the fact that this reacceleration is very recent, I don't think that the Fed is ready to give up on the general direction, which is accommodation. Another thing to take into account, obviously, is that we know that there are some external forces around there, which in any case are probably going to continue taking inflation down. We've been extraordinarily lucky so far, but wholesale energy prices have remained quite tame. Food prices also, generally speaking, have remained quite tame. This is going to help maintain inflation on an okay footing, I would say, even if we probably have to accept that it stays above 2% for a while longer.
So you're betting on a series of 25s here, notwithstanding that pickup that we were just demonstrating. Industrial production we get this week, maybe it'll be softer, but round out that GDP number that still looks stronger than we might have thought just a few months ago. Gilles, we'll leave it there for now. Thanks for your time. Gilles Moec with AXA.